Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. Investature is an impact investment advisor and financed emissions expert led by CEO Scott Ryan. Financed emissions are the greenhouse gas emissions linked to the investment and lending activities of financial institutions, like the investment managers, banks, and insurers employed by 60 million small to mid-sized enterprises in the United States. Financed emissions include the carbon footprint of a firm's qualified retirement plan investments, insurance premium payments, or bank loans, which can negatively impact company growth potential and profit margins. Scott Ryan says we transform our clients' employer-sponsored investment and retirement plans into a catalyst for achieving the firm's sustainable impact and growth goals. Hello, Scott, and welcome to the Sustainable Finance Podcast.
Good morning, Paul. Thank you for having me. I'm looking forward to our conversation today.
Yes, and so we're going to get right into the questions here because we got a lot of ground to cover. First question for you is, what is the financial supply chain, which is also often referred to as supply chain finance, and why is it so important for businesses and their employees to be aware of it?
Yeah, it's a great question, and it's probably a wonky term for some listeners. So let me try to explain it a little bit more fully. When you think about supply chain in the context of environmental impact and emissions, people always think about supply chain like if you're Amazon or Walmart. But finances is also a very important part about the supply chain for emissions in the realm of scope 3. And there's really two parts. There's the external supply chain and the internal supply chain. So when you think about the external supply chain, that's where most of society has been focused, where banks and financial institutions are using their balance sheet to lend to customers. That's the external part of the financial supply chain. What I mostly want to talk about today is actually the internal part of the financial supply chain, which is what are companies, whether they're a bank, whether they're a technology company, professional services, a university as an organization, what are they using in their financial supply chain for internal use? And internal use, one of the biggest things is the retirement plan of the employees. It may also be things like the endowment or how the treasury uses their balance sheet. But typically for most companies and universities, the largest dollar figure of their internal financial supply chain is their 401k plan or their 403b plan. Now, why is that important? If you think about the evolution of the climate movement and how we try to get more disclosure and accountability. We started with things that organizations can control, whether they're buildings or energy, all scope 1 and scope 2, which is great. Then we moved to supply chain for manufacturing and packaging. Then we moved to downstream for oil and gas companies so that when plastics are being made and gas is being consumed, we're accounting for that. But there's the biggest part from a total emission standpoint for most organizations is actually their financed emissions, which are part of their financial supply chain. And one of the things that often is talked about in carbon disclosures, right, whether it's through PCAF guidelines, TCFD, Global Reporting Initiative, you name it, is what is material. Materiality is how much impact am I having, and do I have control over it? And so one of the things that I wanted to tackle when I moved into the climate industry is the materiality and the impact of 401k plans and 403b plans. The dollar figures are huge. Some estimates say for companies like a professional services or a technology company, the financed emissions from your 401k plan might be 10 to 20 times bigger than all of your other emissions combined. And that's a huge thing for people to be aware of. And it's a huge thing for both employees and employers to deem material. That's a lot of financial impact that you can have on furthering the climate, or said differently, if you aren't conscious about those investment choices, either what investment choices an employer is giving their employee, or what investments the employee is demanding of their employer, or what investments the employee is actually choosing within their 401k plan, The unawareness and lack of action or intentionality about that is actually a drag on the climate, not just a neutral effect. And so I founded my company Investature with a cheesy 1980s tag name, but invest in the future, invest in nature, to try to catalyze those trillions of dollars, the 12 trillion that's in the US 401k market, to make it more good for the environment.
Scott, I interviewed someone who's chief investment officer for a large hospital chain, and the firm has all of this capital that they're working with, and it's exactly what you're saying. You know, they have to be very careful about how they deploy their assets within those investment accounts so that they do reduce their carbon emissions that way as well. Now, what are the actions that employers and employees can take to catalyze sustainable goals within their company's financial supply chain?
Yeah, so it's really a good question because it's not just one actor that's at play. There's really two things that have an opportunity for improvement. So one is employers should be offering investments that both their employees want and are in line with their sustainability goals. And second, employees need to pay attention to their 401k and 403b plan. Employees tend to not pay attention, right? As I interview people and expanding my company Investature, a lot of people don't even know what they're invested in or remember where they can change their investments, right? And so here's the things you can do, and here's where I am focusing all my efforts. The first thing is that most 401k plans have what are called target date funds. So it's a fund that has a glide path to change your mix of stock and bond and cash as you age. And it's typically the default investment in retirement accounts so that it makes it easy for an employee to set it and then forget it, which is part of what financial education has been around retirement plans for decades. The problem with that is that people are forgetting it and not intentionally choosing what they invest in. The other problem is that most target date funds get rated by organizations like As You Sow, headed by Andy Behar, as a D or an F in terms of how good they are for the climate. And so what we do for Investature is two employers, we say target date funds make sense because not every employee is going to really be able to pay attention, but let's focus on making those more sustainable. And so we focus our investment advice on having double bottom line target date funds be offered to employees, because those target date funds today are half of the total 401k assets under management and 75% of the net new asset flows. That's a huge dollar figure that is basically what I refer to as zombie money. And that zombie money is very often being destructive to the climate. And so it's demand a better target date fund as an employee and as an employer, make sure you're seeking it out and offering it. The second thing that is really important is that if you think about what venture capitalists are doing and private equity funds, they're investing directly in climate solutions. In fact, I think about 12% of the total investments in the past year from VC and PE money were climate solutions. That's up from 2% 10 years ago, and it's basically been linear growth ever since. Now, if you think about people, 80% of employees want to be investing in sustainable investments, a portion of their retirement. Yet only 10% of employers are offering them something sustainable. Why not offer climate solution mutual funds and ETFs to employees? They are asking for it. It'll help you achieve your sustainable goals. And the smartest investors in the world, VCs and PEs, are investing 12% of their money in it. And so what we also focus on is to say, let's make a better target date fund and add a climate solution fund or two to your lineup. Educate your employees about it so that they can intentionally invest some of their money in that, in addition to the employee base that's more suited to a better target date fund. Let me be more specific about actions people can take at employers. So people who are people leaders, whether you're in HR or you're just a leader of people at your organization, you should be more active in making sure that your employees are given investment choices they want, and also helping make sure that they're paying attention to their retirement benefit. It is a huge expense for the company. It is a huge entitlement and a benefit that employees achieve, but it's a commodity right now. Help make sure that's valued and intentionally used. Second, if you're a sustainability champion or if you're sustainability minded, learn about the impact of the financial supply chain that we're talking about and realize, hey, this is a huge lever that we can greatly accelerate our net zero goals and then start implementing that over time along with your other scope 3 aspirations.
So zombie money, that's a very good description, I think, of that pool of that huge pool of capital. So why hasn't the defined contribution retirement plan market already been catalyzed? And are we making sustainable progress in that direction?
Yeah, so I think it's important to just think about the history of the DC market, which really, it was invented in the 70s, but it became to prominence in the 90s in the US, right? And so it was a shift from defined benefits or pensions, right, into having individual choice for your retirement. The reason it was created was twofold. One is because Americans wanted choice. They wanted to have choice, to have greater returns on some of the conservative investments that their pensions were giving them. So they asked for the choice. Second, it also gave companies a little more accounting flexibility in how they manage that benefit plan. So when they first started, everybody was saying, great, I have these choices. Now I'm going to spend half an hour, 2 hours, right, of looking actively at what investment choices I now have and allocate my paycheck to it. That was great. There was intentionality in the 90s. Then people stopped paying attention because it wasn't new in the aughts and the 10s and the 20s. So most of it is the financial education that says set it and forget it. And the entire defined contribution industry promoting default investments, default ramps, and making it easier for employees to forget it. All of the defaults, though, are traditional investments like existed in the 70s and the 80s and the 90s. They were balanced funds, or now the target date funds. They were even as simple as money market funds. None of those are great for an employee's financial wellness, but they're safe. And none of them consider new investment vehicles that are climate friendly, climate positive. The Climate Solutions Investment Sleeve within mutual funds and ETFs only started existing about 5 years ago, right? And there's over 100 funds that Investature qualifies as an environmental solution fund. But the investment choices that employers are giving to their employees are still using the taxonomy of investment choices from 30 years ago. And they're not including new sleeves, and they're not taking on the chance of something new that their employees actually want. And employees don't know that their employer is actually who manages the investment choices they have. Most employees think it's the system they log into. They look at their balance. They think it's Fidelity, Empower, ADP. It's not. Your employer, your HR leaders, and the investment committee of your retirement plan is actually who decides what investment choices you make. And it's companies like mine that guide them as to what choices to give you to meet with market demand.
So, Scott, I think it's becoming pretty clear why our followers should choose to shift their focus within allocation of a retirement investment plan. Tell us why you chose to shift your career into sustainable technology and investing just over a year ago. I've got a pretty good idea why. I think our followers do too, but expand on that a bit.
Yeah, and so just like everyone else, my career has been a journey, right? And in my private life, my number one cause has been the environment, right? Ever since I was a teenager. And I've been doing environmental initiatives at my companies, but my day job was never being paid to focus on the environment, right? And my day job for my prior career was working at companies like Accenture, Morgan Stanley, Bank of America, and Salesforce. So a breadth of consulting, wealth and asset management, and high tech, always in go-to-market functions. But I was never doing enough for the environment, but also the time wasn't right for me. And so last year, I was one of the many people who wants to do more for the climate, but also in my personal life, the timing could be right for me to provide my skills to the urgent need of solving the climate crisis, right? And so, I have to say, it has been the most refreshing professional change I've ever done. The community of people that are involved in trying to solve the climate crisis are constantly proactively helping me learn more, helping me do introductions. And so even on a personal level, I feel like I'm genuinely doing more than just donating money to the Natural Resource Defense Council, an organization that I'm on the advisory board for, or planting trees in my local community. But that I'm I'm constantly being coached by people who've been doing this for decades before me to do it better so that my newer entry to the field can help have impact and people support or help round out the idea that I'm trying to do, which is catalyze and shift trillions of dollars in the $12 trillion US 401k 403 market to be double bottom line investments that are both good for your wallet and good for the environment. And it's been a great experience.
That's great. I'm really glad that you've joined the movement, Scott. I've been in it for about 20 years or so, as you know from our previous conversations. Please give us a brief description of the climate finance gap and why it's important for people to understand, especially those that are contributing to these types of retirement plans, the magnitude of that gap.
Yeah, and so one of the things that is really important for people to understand is the scale of need that financial levers can have to benefit the climate, or how inaction on financial levers can act the scale of the harm it can cause. Right. So the Climate Policy Institute, which is one of the leading neutral parties that talk about that align to the Paris Accords, has stated a goal of about $6 to $7 trillion a year needs to be spent on climate solutions, right, to align to the 1.5 degree target that also has consumption choices and policy choices around the world related to it. Today, climate solutions get investment levels of about $1.5 to $1.8 trillion. So big numbers. I'm saying trillions, and trillions is important, right? But 1.5 to 1.8 out of 6 trillion, we're a third of the way there, a quarter to a third of the way there. The good news is that investment numerator has been growing, right? It was 1 trillion just 2 to 3 years ago. It was in the 500 billions 5-6 years ago. So that numerator is closing out of the 6 trillion needed, but it's still a long way to go, right? And what happens often for people who want to do more for the climate is they talk about in the scale of millions and billions, right? So when there's a new private venture fund that's invested in nature-based solutions, they're like, we've got this fund, it's amazing. We have 100 million in assets under management, right? That's millions where we need to be hitting trillions. People were donating hundreds or thousands of their private money, right? And through charitable contributions, but the magnitude is trillions, right? And so what I try to teach people, and what was enlightening for me when I studied Project Drawdown, is that the trillions that we need, and also those trillions need to be focused not just on clean energy and electric vehicles, they need to be focused on the built environment, nature-based solutions, the circular economy, and adaptation. Right now, 90% of that 1.5 trillion goes to clean energy and transportation. The other solution areas, nature-based, circular economy, built environment, adaptation, they are actually 60% of the solution. They're getting 10% of the investment. So not only is more money needed, but also that money needs to be pointed at a broader diversity of solutions. And where we think there's a real opportunity to help is the 12 trillion. Again, I'm talking trillions in the US 401k market. Only 50 billion of that 12 trillion today is invested sustainably. We can shift billions and trillions of that in the next few years. It can be meaningful at having the US economy help contribute to closing the climate finance gap versus right now contributing with zombie money to actually hurting and being an anchor against the climate solutions.
Scott, tell us just a little bit more about Project Drawdown, and if you would include a link in the information that we're going to attach to this episode, I'd appreciate that, so people can get an expanded idea of what you're focusing on and what many people within the industry are now focusing on. And tell us just a little bit. Don't name any names, but investment strategies that you're currently discussing with clients who work for these small and mid-sized enterprises.
Yeah, and it feels funny for me because I call myself, I'm in my sophomore year of being in the climate industry, and I'm talking to you, Paul, who's been doing this for decades, to teach you and your audience about Project Drawdown, but let me give it a shot.
This is what keeps us young, right? And forging ahead. Go ahead.
Yeah. But so Project Drawdown for me has been, everyone reads different research that resonates with them. right? And Project Drawdown has been the research that has been the foundation for all of my decisions of where I've tried to focus my energy and other people's energy, right? And Project Drawdown, I think first came out maybe 15 years ago, but it talked about the 100 solutions that the world can take now that can most effectively, from an ROI standpoint, better the climate, right? But within that, and Project Drawdown continues to refresh that list. But one of the other things that Project Drawdown does, and Jonathan Foley as the great champion of this, is helps it with a taxonomy for the world to follow. And they didn't do it unilaterally, right? They did it with a lot of collaboration. But I think it's well and simplistically stated for people to follow. That there's 5 major climate solution buckets for mitigation, and then there's adaptation and resilience in terms of surviving the change that's already happened. Right. And so the Project Drawdown talks about that, those 5 I mentioned before: the energy system, the transportation / mobility, the built environment. The built environment is the most complicated one. It's buildings and roadways. How do you make buildings more efficient? How do you create hard to abate construction through concrete? It's a very complicated one, right? Nature-based solutions, which include watersheds, oceans, forests, sustainable agriculture, and then circular economy, the reduce, reuse, recycle that 3-year-olds are taught, as well as 93-year-olds, but how to make that more tangible. And so I highly encourage everybody to study Project Drawdown. They have good 1 to 2 hour videos that explain the different solution buckets, and also where, for you as an individual, for what resonates with you, here's menus of 100 different things to focus your time and energy on, whether it's your financial time, your sweat equity, influencing your community and your friends. They do an amazing job pointing us to the answers. We just need to follow their lead. So when we talk about investment strategies, right, we are talking about target date funds because there's so much money invested in there, and making those better, it can be so impactful so quickly. The second is within climate solutions. One of the climate solutions that we actually would want help from your listening audience is around nature-based solutions that are more easily invested into by retail investors. Right. And so anyone who's working on structuring a open-ended private fund or a mutual fund or an ETF that's focuses the underlying investments are ocean-based or land-based, nature-based solutions, please reach out to us, because we want to help evaluate those and make them available to more employees to select.
Terrific. Scott, we've been following the solution buckets in our programming, and you've seen a number of our episodes where we're talking to people in those different solution buckets and the technologies that they're developing. So let's find out where our followers can go online to learn more about Investature's services and how they can get in touch with you to discuss the topics that we've talked about in today's episode.
Yeah, so thank you, Paul. So Investature, the spelling is invest in nature, invest in the future. So invest, A-T-U-R-E. We have a website, investature.com, a LinkedIn page. So please follow us and come contact us on the website. And let me just simply describe our offerings. We offer to employers investment choices for the 401k plans and 403 plans that employees want, right? That is in target date funds, that is in climate solution funds, as well as every other traditional asset sleeve, but we're focusing on those 2 the most. The second thing we do is we actually help employers, the sustainability officer, understand the impact of their financial supply chain. Right. So the stats I said at the beginning of the call, here's the math for your 401k plan's contribution to that 10 to 20 times more emissions than anything else at your employer, to help understand the math and how to bring that down so that can be a catalyst to achieving your net zero goals. And then the last thing we do is once we're offering the investments you want, you understand the financial impact at both an employer and an employee level of your investment choices, we help with the adoption. So we do personalized financial wellness, personalized investment allocation through technology. We are actually a record keeper, right? So if you wanted to log in, you can use our services backed by a large institution that manages 15% of the market. We will give you that experience where the investment allocation and intentionally investing is at the forefront of what you see, versus just most record keeping platforms that you log into are things that just help you with transactions, help you make sure your paycheck is being put in, and helping you see your balance, which is commoditized. We do that too. but the how you invest is really important, and Investature can help you with that.
Great. Well, thanks to Scott Ryan of Investature, and thanks also to our followers of the Sustainable Finance Podcast for joining us today. And join me next week for another episode. I'm your host, Paul Ellis, and this is the Sustainable Finance Podcast.